Hi everyone. In this video, we'll review the accounting for a merchandising business. As always, you will get the most value from these study guide examples if you will take time to pause the video and prepare the calculations and journal entries. Then start the video again to check your answer. If you got it right, you'll feel great. If you didn't get it right, there will be a detailed analysis of the correct answer that should give you an opportunity to understand and fix your errors. Number 1. A company had net sales of $741,800. Its cost of goods sold must have been what to yield a gross profit of $282,884. Please pause the video, calculate your answer, then start the video again to check your work. Cost of goods sold had to have been $458,916. Remember that net sales minus cost of goods sold equals gross profit. So you can change that formula around a little bit. Net sales minus gross profit equals cost of goods sold. $741,800 of net sales minus $282,884 of gross profit yields $458,916 of cost of goods sold. Given the information in number 1 above, calculate the company's gross margin ratio. Show your answer as a percentage rounded to 2 decimal places. The gross margin ratio is gross profit divided by net sales. $282,884 of gross profit divided by $741,800 of net sales equals 0.39575. Rounded to 2 decimal places. As a percentage, that would be 39.58%. Number 2. Which inventory system continually updates accounting records for merchandise transactions for the amounts of inventory available for sale and inventory sold? That would be the perpetual inventory system as opposed to the periodic inventory system. Number 3. A company purchased $8,750 worth of merchandise with credit terms of 210 net 30. The invoice was paid within the discount period. Accordingly, the company received a cash discount of how much? Credit terms of 210 net 30 mean that the purchaser or buyer is allowed to take a 2% discount if they pay the invoice within 10 days. Otherwise, they have to pay the entire invoice without a discount within 30 days. Therefore, by paying it within the discount period, they received a discount amount of $175, calculated as $8,750 times 2%. Using the terminology provided in your textbook, FOB what means the buyer accepts ownership when the goods depart the seller's place of business. The buyer is responsible for paying the shipping costs and bears risk of damage or risk of loss when the goods are in transit. That would be FOB shipping point. Okay, let's do an acid test ratio problem. As of June 30th, X1, a company has the following assets and liabilities. Cash and cash equivalents are $14,500. Accounts receivable is $22,000. Inventory is $15,000. Short-term investments are $55,000. Office equipment is $105,000. Accounts payable is $12,900. Long-term notes payable are $88,000. Compute the company's acid test ratio as of June 30th, 20X1. The acid test ratio is calculated by dividing quick assets by current liabilities. So the first thing we have to do is to find the company's quick assets. Quick assets consist of cash and cash equivalents, short-term receivables, and short-term investments. No other assets are included as quick assets. So cash and cash equivalents of $14,500 plus accounts receivable of $22,000 plus short-term investments of $55,000 equal quick assets of $91,500. Current liabilities in this example consists only of accounts payable, $12,900. The only other liability the company has is a long-term note payable. Well, if it says it's long-term, it ain't current. So only accounts payable is current. The acid test ratio, then, is quick assets of $91,500 divided by current liabilities of $12,900. That equals 7.0930 or 7.09 or 7.1. After going over the answer for number 5, number 6 should be really easy. Quick assets are defined as A, cash and cash equivalents, short-term investments, and inventory. B, cash and cash equivalents, short-term investments, and current receivables. C, cash and cash equivalents, inventory, and current receivables. D, cash and cash equivalents, non-current receivables, and prepaid expenses. Or E, accounts receivable, inventory, and prepaid expenses. Please select your answer, then start the video again to check your work. The answer is B. Quick assets are defined as cash and cash equivalents, short-term investments, and current receivables. A trade discount is what? A term used by a purchaser to describe a cash discount given to customers for prompt payment. Or B, a reduction in price below list price. Or C, a term used by a seller to describe a cash discount granted to customers for prompt payment. Or D, a reduction in price for prompt payment. Or E, is also called a rebate. Now, you would have had to read your textbook pretty carefully to find this, but it is in your textbook. And the answer is B. A trade discount is a reduction in price below the list price. Now, this would have been a little hard for you to have read in the textbook because it's in pretty small print. But I do want to take this opportunity to let you know that there is a glossary at the back of your textbook. If there's some obscure term that you're not quite sure about and it's on the exam and you don't have much time to finish the exam, rather than paging through a chapter, you might try the index at the back of the book to help you find what you're looking for. If you refer to the textbook too frequently during the exam, you won't have time to finish the exam. So please study hard, and hopefully you won't have to refer to the textbook. Well, that's all for this video. When we come back, we'll finish this study guide worksheet by writing a whole bunch of journal entries to record merchandising transactions. See you next time.